Our main funds invest in later stage companies, and we've probably got about 600 or 700 million under management there.
What is your number one piece of advice?
Don't start a restaurant.
What has been your personal biggest mistake that you've made?
There's this expectation that, I'm going to invest in this one stock and it's going to blow up and I'm going to get rich overnight I can go live the life, right? What people don't see is the thousands, if not millions of people that lose a fortune on those.
Thank you, dude.
Right.
Oh, that was awesome.
Good job, man.
What's going on, everybody? Welcome back to another video. Today we're joined by Arden Che. Arden is a very experienced investor, and I'm very grateful to have you on today. And thank you so much for your time. And on behalf of the audience and myself, we really appreciate you being here. So tell us a bit about yourself, and then we'll hop right into the questions.
Oh, my pleasure. So as you mentioned, I've worked in investment management for most of my career, and I've been very fortunate to manage 3 different asset classes professionally: commercial real estate, public equities, and now venture capital. And the firm that I'm currently with, Yaletown Partners, we're based out of Vancouver, is a venture capital firm, one of Canada's oldest and longest running venture capital firms. So the team that I work with, we manage the early stage investments out of a series of smaller funds. So in total, we've got about 50 million under management between those funds. And these are companies that are pre-Series A, early stage, right? They're just getting started out, have early revenues. They haven't quite scaled or grown yet. So that's the stage we invest in. Yaletown, our flagship series of funds, our main funds invest in later stage companies, and we've probably got about 600 or 700 million under management there. So our firm in total, we have about 750 under management. And again, the team that I work with and I run, we invest in the early stage companies.
The first question I want to ask is, obviously you've been in the investing game for a long time, and you've seen some companies scale and some companies go down and crash and burn. What makes a great company, and what makes a company successful?
Well, if I knew that, I probably wouldn't have to work anymore.
Yeah.
I think one commonality, especially if we're talking in venture in the early stage, specifically where we invest, we're looking at companies that don't have a proven track record yet, right? And they don't have a lot of numbers to crunch. I call it qualitative finance at this stage. And so what we really have to look for is how strong the founders are, how strong the team is. And when I say strength, it's a combination of things. It's things like how much experience do they have in this sector, right? You want to have people that have deep technical knowledge or who have come from the industry that they're solving a problem for. And I think another thing is their coachability and their ability to change and essentially adapt to things in the market. I think a lesson that I've seen is, when a business plan hits reality, reality wins every time. And the best teams are the one that recognize that and can change quickly and not get completely stuck on one way of doing things. And we have portfolio companies that have actually had to change their offering. We call that a pivot in this industry. And adapt to whatever is happening in the market to where they're seeing the demand. And they've done well, right? And I've seen a number of companies do that. So I think adaptability is probably the number one characteristic that I would help define success in a company. That and that resilience and persistence thing, not giving up too soon. So yeah, until you've actually got proven revenues and and product market fit, really it's about being able to read the market, move quickly, and adapt.
What has been your personal biggest mistake that you've made in either business or investing, and what did you learn from it?
Oh gosh. So I have also been a business owner / entrepreneur. It wasn't in tech, but I had some partners, and about 10 years ago we started a restaurant, which is a very difficult business model. And I think probably this relates to what I said earlier about when a business plan meets reality, reality wins every time. So you can model your business as much as you want and as much detail as you want, but it's really a work of fiction until the rubber hits the road. And I think it's important to talk to customers, but also talk to other people who have been in the industry, learn from them. I think while I don't regret what we did and the adventure we went on, it could have been smoother if we would have spent a bit more time talking to others who had already been in the industry and done it at a certain level of depth. But other than that, I think it's all a learning game. Entrepreneurship is a game of learning. The entrepreneur that learns the fastest is usually the one that survives and wins. As far as my own mistakes go, I think a little bit a little bit too much trust in a model versus what actually happens in reality. And again, this is me 10 years ago, fresh out of an MBA, and kind of really you got that confidence, will you say that? We know business. But something as simple as a restaurant can still be very complex because in the real world, there's a lot of issues that come up that don't get modeled into a spreadsheet. And so I would say, that's certainly a piece of advice that I would offer, and that I was given at one point in a different industry, is that if you want to do something, try to find people that have already done it and learn from them rather than recreate all their mistakes on your own. You'll save yourself a lot of time.
For sure. That's why I'm talking to you.
All right.
Yeah.
Just happy to offer what I can.
The world right now is pretty crazy. What would you say to people that are trying to build wealth, build their own net worth, and get rich in today's economy? What is your number one piece of advice?
Don't start a restaurant. But in all seriousness, I think the important thing is understanding that you won't build. Number one, time is your best asset, right? The longer you have to be in the markets, the better. The second is you don't have not to rely on any one source of capital or wealth or investment for your retirement. It's about, unless you're one of those lucky people that has a pension, you're really going to want to try to diversify your holdings. And I think it's important to look at investing in yourself. So there's a investor in the U.S., Cullen Roche, and he wrote this great book about 10 years ago called Pragmatic Capitalism. And he's got a fund called Disciplined Funds. I follow him quite a bit because he's just a really intelligent guy, and what he says really lines up with my own values. But a long time ago, I came across his writings, and he talks about this concept of how the public equity markets, right, the stock market, that's not truly investment. If you look at the definition of investment, it's about creating value and then being able to capitalize on or extract that value. But what does that mean? That means when you invest in a business, a private business, a small company, or a venture, or whatever it is, the company gets to take that money, grow, create value, and hopefully that comes back to you in terms of some sort of profit, right? When you're buying stocks in the stock market, unless it's an IPO, that money isn't going to the company. You're essentially trading cards with other investors based on what you think it's going to be worth. So is that actually creating value? I would argue not, right? As Cullen does. But what the stock market is, it is a allocation of your savings into a different vehicle that can earn, you're shooting for that kind of 8 to 12% per year mark. I think when you look at what's happened in the last few years with meme stocks and such, there's this expectation that I'm going to invest in this one stock and it's going to blow up and I'm going to get rich overnight I can go live the life, right? And what people don't see is the thousands, if not millions, of people that lose a fortune on those. Typically, the people making money on those stocks are not the ones you see, right, or that right?
Definitely.
And so. It's a dangerous notion about getting rich on the stock market because those aren't your typical returns. That's gambling. It's just no different than going to Vegas and throwing everything you got on red, right? On the roulette wheel.
For sure.
And so, understanding that, okay, the stock market is one place you can put some of your savings and expect a certain rate of return and understand the math on that. But the other is investing in not only, number one, yourself. So whether it's training, your education, that's going to help you build a skill set that can command higher earnings. And that gives you more capital to invest. And the other is in private companies or running your own company, right? Being an entrepreneur, essentially, and starting a business. There's probably all the people I know who are kind of in that ultra high net worth category make it in one of two ways. Either they were entrepreneurs and ran their own businesses, or they were investment professionals and knew where to allocate that money. We get taxed an immense amount on our income, right? I mean, you were talking, if you're an average earner, anywhere from 30 to 40% of your income gets taxed. And so it's not a very efficient way to build wealth. But capital gains, investments, dividends, all that sort of thing, you get to keep more of it. So that's another principle, right? It's not about always about how much you make, it's how much you keep. So really understanding all that and taking the time to is important. I think the biggest downfall of our education system is that we don't teach young people financial literacy and how to invest and how the markets work. And that's probably one of the greatest things you can learn at a young age, to be in the markets, to be investing, to look at opportunities, to grow, start your own business, etc. So, yeah, I mean, it's a bit of a long-winded answer, but it is not as simple like, do this one thing, you'll get rich, right? I hope what I'm able to impart for the audience and everybody who's kind of early in your career, or even later on, is that it's not just one thing. And you need to diversify if you want to really grow wealth. And hopefully, we get some more entrepreneurs out of that in society.
I'm sure you've learned a lot with where you've worked and being in the venture capital world and the real estate world and public equities. How has what you've learned at your job and how you invest at a company like Yaletown, how has that transferred into your own personal investment strategy, and what do you invest in?
In managing my own wealth, the important things, as mentioned before, is about diversification, right? Not necessarily just within public equities, but in asset classes. I'm not banking on any one thing to make my retirement. It's going to be a combination of things. Having said that, I get enough high risk from my job, being exposed to tech, because in venture capital we do get what's called carried interest, right? And so, which is essentially profit sharing. Once the companies in our fund exit and we've sold off our positions, the profit on that gets split between us and the other investors. And so that's my exposure to startups and private equity and tech, and that's good. I've got that at least, right? In my own public equity portfolio, it's pretty boring. I like simple, straightforward, like Costco, right?
Yeah.
I've got, some energy stocks. I've got some, so, I don't venture too far. I've got enough exposure to tech through, to my work. And then when it comes to like private investments, I try to get involved, again, in cash flowing industries where I stopped doing angel investing in tech startups a while back. And that's, again, because a part of it is too because I realized that I need to build a personal portfolio of about 20 or 30 companies in order to manage risk properly. And I just didn't have the time or wherewithal to build a startup portfolio that big for myself. So luckily I have exposure again through work. But in small companies, like I'm invested in a local liquor company, right? That has a really cool product that we're out in Atlanta and New York now, and once we grow to a certain level and are able to sell that, we'll put it into a syndicate of friends and stuff we invest together. We'll be looking for, again, cash flowing businesses, stuff that's, again, profitable, boring, not too volatile. Because that's really building wealth, and I've learned from again some of my ultra high net worth friends, is a slow and steady process. It's not an overnight process. Get rich quick is what you see all those people on the internet that are selling their programs, their schemes. Well, they're getting rich by selling you those programs.
For sure.
Not to say you can't learn something from them, but I'm always trying to I think an important thing is trying to understand what's somebody's incentive, what's their motivation for doing something. You're not doing this online course out of the good of your, goodness of your heart to, educate the masses and make sure everybody has. You're going to make money off of this, right? You're charging $1,000 for this seminar. You're doing whatever. Fine. I'm not saying that, again, you can't learn anything from folks like that, but understand that getting rich quick is it's a very shiny object that many people will chase because they don't have the patience. And we live in today's age of the attention economy and expecting things to happen instantaneously. I mean, come on, who actually has the patience to wait 20 years to build your retirement fund? But that's the reality, right? Because when you understand how powerful compounding is, when you understand how powerful building your career mileage and your career credibility is, all of those things, for all the young folks out there, you reap the rewards 2 or 3 decades down the road, and believe me, it's worth it. But if you spend all your time trying to find the next get-rich-quick scheme, you're missing out on the ability to compound and slowly build your wealth. And I'm not saying that you can't do it the other way, but when you look at the odds, right? And if you do, and if you're one of those people that happens to hit on something and goes viral, great. Like I said, there's no one way to do it, and whoever makes money is
You're
right.
right if you're making money.
Exactly.
Yeah.
But I would say, if you're playing the odds for the majority and you think about principles of wealth management and building wealth, it is that time is your greatest asset, and it's important to be patient and have those opportunities come to you, over time. But instead of wasting money and chasing things that might make you rich overnight, you might as well go to the casino.
So you have roughly 30 companies as a part of your portfolio and all of the funds that you manage. What is a big red flag that you can see and see early when a founder is pitching you their company that would make you definitely not invest in that company?
Well, considering that we invest at a stage when there's some early revenue, we're not coming in at the earliest stage. But I think a commonality I would see is the strongest companies are the ones that have talked to their customers and are continually talking to their customers and getting feedback from them and then improving their product based on talking to their customers. Especially if you're a software company that's selling. I think if you are kind of developing your product in a vacuum, and the ones that, you get some early initial traction and you think, oh, I've got some sales, and then you kind of just turn back and focus on the product, that can be a big mistake, because ultimately the only way you survive is by selling, and selling something people want. And if you assume that these first 5 customers are your ideal customers and that all your customers are going to be like them, that's probably too small of a sample size, right? And I guess another kind of a red flag is always when you hear somebody say, well, I see this as a problem, and they think that their perspective is the only one. Well, you're a market of one, right? It's like, for me, even if I look at the entrepreneur's concept and I don't think it's a good one, I'm not the market. So I'm always asking, okay, who have you talked to, right? Tell me what your customers are saying. Because it's the market that'll tell you if you actually have something or not, generally, when you're trying to start a business. It's a very interesting industry we work in because, you look at truly disruptive companies often don't even know their market at first. And they're putting something out there that nobody really wants. But at some point, what the economy and the market catches up to what they're doing, and there's a shift. Clayton Christensen's Innovator's Dilemma does a great job of explaining this. But I think for the most part, like 70-80% of what we're looking at out there is about sales, understanding the market, and solving a problem for people that they're willing to pay for. And I think that's the number one thing. So anytime I hear somebody say something like, if you could only see what I see, this is, I know this is a problem. I've lived this. Well, great. How many other customers have? Because you alone are not enough to make up an entire market. In
your career, has there ever been an investment or opportunity that slid across your desk that you said, maybe this isn't the right time for me to hop into this investment, but later on maybe you regretted it, or you saw that company scale, or did you have any general regrets in missing out on companies?
I think in my investing career, professionally, I would say no, because what I've learned over time as a professional investor is that what you have to develop is a framework, a thesis, right? You have to a way of looking at the world. I always try to impart upon the analysts and associates I work with that becoming a good investor, at least this way I was taught, is really developing your own perspective on the world and understanding where you see value and how you see it being derived, and upon what conditions you would invest in something. Nobody knows 100% if a company is going to do well and they're going to skyrocket or whatever. There are some things that are just out of your control. So you don't have any control over the outcome as an investor. I mean, you have hard enough control over the outcome as a founder. As an investor, right? All you can do is do an analysis. But what you do have control over is your process. And if you have a disciplined and structured process, then you know that what you can do is revisit it and go, okay, we missed on this one, we missed on that one. You can't get them all. Why did we miss out on that one? Okay, what did we learn? And if you look at it from that perspective, it's hard. You can't regret, right? Because you didn't do something stupid. There was something about your framework that missed this, and you can ask yourself, are we okay with that, right? Because with our framework, we're not going to overpay for something. And if that means we miss out on something that's really skyrockets, we're okay with that, because in general, over the long run, our model works for us. If you don't have a thesis or a framework, you're really just guessing. And especially in the professional management world, if you're trying to attract money from institutional investors and such, it's really hard to sell them on the fact that, hey, I'm really good at guessing. But if you can say, look, this is our framework, this is how we see the world, this is where we see the opportunities, and these are the parameters under which we will invest, that's 90% of it, right? There is a 10% of a gut feel where, as an investor over time with your mileage, you get a sense of, is this entrepreneur for real, right? But again, even in the Valley, you get, the Theranos happening, you get the WeWorks happening, even the best investors can get fooled. But what was the investment framework you used for that? Now, personally, yes, I do have regrets about some of the companies I invested in many years ago, and that's out of the fact I didn't have a framework, I didn't have a thesis. It was just what was hot for the day, and anybody who was around during right before the dot-com crash. I mean, my friends and I had this little investment club, and this is before I got into professional investing as a career. And we invested in things like the AOL Time Warner merger. We invested in Bre-X. We invested in a bunch of names from back then. And anybody out there who's Gen X or older will know these names. They didn't go so well. But we were just guessing it. And what we were doing was we were relying on what we saw in the news. If you're relying on what you see in the news, you're already too late, right, for information. So there was no fundamental analysis. There was no thesis. It was just like, hey, this looks hot. Let's invest in it. Scarily enough, I still have friends who do that, but they're not retiring off of those funds, let's just say. But yeah, that's probably, that's how I would look at it, right?
So 2 follow-up questions there. One is, would you be able to dive a little bit further into what that framework looks like? And then the second one is, where do you actually source your information from?
The beautiful thing about, I'll answer the second question first, is that when it comes to looking for information, there's all kinds of things that are available in the public markets now, right? And on the internet. But when it comes to startups, a lot of it also comes down to, so it depends on what you're investigating, right? And when you're doing your due diligence. But for example, when you're talking about a founder, you can talk to people that have worked with that founder. You can look at, their history and really you have to do some detective work, right? And look at their, the results that they produce, what's their track record. When it comes to a market, you can talk to people who are industry experts. You can, start understanding what's going on in that space. And you can also combine that with publicly available information. When it comes to the stock market, it's really hard to get anything. It's a game of the fastest algorithms now, right? And I think, it is a very challenging time now to be a retail value investor, because you don't have access to the resources. For example, like, the guys I used to work with over at Aimco, they could fly to Japan and meet the CEOs of these companies, right? That they were looking to invest in. You don't have that, right? Nope. And so that's why, honestly, the ETF approach for me is a good, easy, lazy, which is a good term in this sense.
Low cost.
To do it, low cost way to do it, right? Because you're never going to have, for example, if I want exposure to Japanese stocks, I've invested through Berkshire Hathaway. Right, Berkshire B, not Berkshire A, because Buffett and his team have actually been able to go and talk to Mitsui and talk to all the companies. They figured it out. They're investing. So that's another thing you can do very powerfully through public equities is get the underlying exposure. Right, if you want exposure to another market, but you don't have the resources to research that market. Well, if you can invest in a company that is, invested in that market, that's another way to get that exposure. And so where we get information, right? It's in all kinds of places, but what I love about venture capital is that you can talk to people, right? And really investigate. Now, when it comes to example of an investment framework, it can be as simple as, for example, our latest fund. Our thesis is we look at life science companies, artificial intelligence support driven companies, or enabled companies. We don't necessarily, and we don't invest in AI itself, like LLMs and such. That's you need very deep pockets to invest in that, right? But what we do is we realize that AI is changing the software industry significantly, and there are some real opportunities with companies that are doing it well. And then the third is digital transformation, which is taking old industrial type industries or any analog type industries and modernizing them and digitizing them, right, and putting them, bringing them into the modern age, if you will. So those are kind of like the three pillars of our thesis. So number one, that eliminates things like marketplaces or Bitcoin or, you know what I mean? Like, it gives us, okay, here's the envelope that we're going to play in. Now within those, we have certain things that we look for. So for example, if it's a medical device company, we need to see some sort of involvement either as by a strategic, so which means a player that's out there in the industry, like a Johnson & Johnson or a Pfizer or whatever, who either is an investor or a customer, right? If it's software, we need to see a minimum level of revenue and, you know, a certain diversity of customers, if we will. And then when it comes to the economics of the deal, we need to, you know, there's a certain check size that we'll cut, right? We don't deviate too far from it because we have an actual model as to how we're going to deploy capital. And so we indicate, okay, for that check size, we need to own a certain percentage, a range, right? Call it 3 to 5% of a company. Well, that kind of puts a bit of a parameter around the valuation we're willing to accept. Because here's something I've also learned in venture. As a public equity investor or any other asset class, right? It's the number one rule. Warren Buffett has said this time and again, don't lose money, right? Venture capital is very different from that. You actually expect to lose money in companies. So I've figured that the worst thing you can do in venture capital is to be right about a company and not make money, because those are rare to find companies that actually break through. But if you paid too much and you end up, I mean, you look at Uber, right? When they IPO'd, all the early investors did really well. The later investors lost money, right? So the idea is, what price are you willing to pay? And the math has to work, right? And I think that's something that being from capital markets I bring to this perspective, is that the laws of math still have to work, you know, for us to make our money. And so unless I have confidence that this industry or this company can yield a $5 billion exit, I'm not going to buy in to own, you know, less than 1% of a company, because the exit won't be worth it. The risk to reward ratio is off. So that's, you know, that's what I talk about in terms of the discipline of, okay, these are the parameters under which we work. And then you get to go revisit them later on and go, were we off anywhere? Do we need to tweak that for the next fund? Because we never used to invest in health tech or life sciences. But because we were starting to see all kinds of companies, like the number of applicants for funding for investment between Fund 2 and Accelerate Fund 2 and 3 for us, like tripled from the life sciences sector.
Wow.
And we couldn't keep just saying, no, we don't look at that. We don't look at that. It's like, okay, there's something going on here. So we actually wrote a new thesis saying, okay, these are the kinds of companies we can look at. These are the parameters, and we continue to refine it. But that's allowed us to get into some really interesting deals and opportunities that, you know, we're excited about that could do very well for our portfolio.
So you have exposure to a lot of technology companies and SaaS businesses where a lot of SaaS businesses operate on retention and growing and scaling their user base of their software. How do companies, whether it's a SaaS business or I guess any business in general, really go from 0 to 1 and then from 1 to 100 clients or customers? Those are two. So good question is that those are two very separate things, right? I mean, 0 to 1 is really about getting a product to the point where you can actually sell it, and that's one set of skills, right? It's about understanding what's good enough, and getting it out there, talking to a bunch of customers, and finding that first one that's going to say yes. If you can solve this problem for me in this way, I will pay you this much for it. That's number one. Once you get that, and you start scaling, I mean, in general, it's as I'd like to say it's as simple, not easy, but it's as simple as being able to sell and focusing on sales. I think there's a lot of people I've met who they're afraid to sell. They don't want to be out there. It's uncomfortable, right? They're hoping that we just build something and people will just see it and buy it. And even the product-led growth strategy requires some sort of touch, right, in selling, and so. It is thinking about that whole experience of your customer and how you're going to sell to them. And how that goes from 1 to 100, I mean, it'll vary depending on your industry and who you're selling to. But it comes down to understanding, the sales channel, your whole advertising and marketing campaign.
I think the most common thing to remember, though, no matter what kind of industry you're in, is can you grow this efficiently and increase your top line without increasing your expenses? Because what it comes down to, scale is about getting economies of scale and growing your margins, right? We understand when you're starting out, you won't be profitable, or that your individual unit economics may not be great. But the way that you overcome that over time is your revenue can grow faster than your expenses. And then you start generating more profit. And there's all kinds of ways about that. It might be, you know what, our salespeople, right? Each one can probably bring on another 100 clients each. So in the beginning, we'll have one person, and until they get to 100, it's not going to be profitable. But then when we get to salesperson 2, and then we start growing the number of, that efficiency, it comes there. It could be that there's certain things we'll be able to automate, right? Or it could be when we get to a certain scale, we're going to be able to reduce costs on these products because we'll get better purchasing power. Whatever it is, when you're thinking about scaling, it's important to remember that you need your revenue to scale faster than your expenses. And again, it is about when you're talking about acquiring customers, focusing on selling, getting out there, and listening to your customers, because as you grow and you start talking to more of them, you're going to start hearing things about the product, and you're going to start hearing things about what they like, what they don't like, what you need. The challenge for every entrepreneur is figuring out what to listen to and what is noise, right? Just because one customer says, oh, you need to change this feature, does that mean you have to get your entire product team together and spend a whole weekend changing something? Or maybe it's, look, we need to see if this is common amongst a bunch of other customers first. Maybe this isn't our ideal customer, right? Or use case. And so I can't emphasize that enough. Sales is a really important skill to have. It's not a case of if you build it, they will come.
Have you ever had any mentors in your career? And if you did, how essential were they to your success?
Well, I'm a big believer in mentorship. I mean, I used to manage the entrepreneur mentorship program at the University of Alberta, the venture mentoring service. And that's where I really saw it formalized. But I think throughout my career, since I was in my 30s, right, my professional career, I always valued having somebody that had more than one person, people with experience ahead of me that I could learn from. And I actually always try to have 2 or 3, that are either, personal, professional, somebody who's much older and more experienced, and somebody who's maybe 3 to 5 years out from where I'm at, so you can get different perspectives and angles. It's kind of like building a personal board of directors, if you will, and you can never start too early, I think. And there's a lot of people with experience that are willing to do that for others. And for me, it's really about, mentorship is really about accelerating your pace of learning, right? And learning and not making the same mistakes that others have already made. There are some mistakes you need to make on your own, and there's some that you don't. But having those people in your life that are willing to share and to offer guidance is just invaluable. It also is another way to open up your networks, right? I think there's a lot of emphasis in business schools and such about make sure you network, make sure you go out and grow your networks, but no one actually ever tells you or teaches you how to do that. Mentorship is one way to do it, I've done entire presentations on how to get mentorship, which I won't go into here and now, but the point is, don't be afraid to ask. Don't be afraid to, look around you, and who do you look up to? Who is doing something that you want to do or want to be down the road? And engage them in a cup of coffee, ask them some questions. It might just be one meeting. It could be, the longest running mentor I've had in my life has been 17 years now.
Wow.
Right? And that longitudinal knowledge helps because, he's always been able to refer back to my decisions in the past and go, well, remember when you made this decision about that? How different are you now from then? And it's invaluable. And so I really treasure that. And so you're never too young to look for a mentor, and even to be a mentor. You can't think of mentorship in a chronological age way either. Younger people have a lot to offer. They're older people, right? And so I always try to get into conversations with people who are younger than myself, especially in the space, because that's the only way you learn about what's going on out there, what's trending, what is catching the attention of the next generation. And that's hugely important. So yes, I've had a number of great mentors in my life, and I will always continue to do so.
All right, everybody. Well, that was the video. Arden, thank you so much. That was awesome.
My pleasure.
You're very knowledgeable, and understanding your experience was just a really cool experience for me, and hopefully for the audience as well. And I know that for sure there was a lot of value in that. So.
Well, this was a lot of fun. I really enjoyed our conversation, and kudos to you for getting this going on your own and just making this happen out of thin air. That's what entrepreneurship is about, and I look forward to watching more of your videos down the road.
Awesome, sounds good. And as always, I wish you all the best of luck on your journey to success. Peace.